Good afternoon to everyone and welcome to our presentation. As you can see on the screen, our topic today is understanding credit instrument, wherein we're going to explain the parties of check, what is payee, bill of exchange, promissory note, and types of credit instrument.
Good day everyone. I am Laimi Kulagbang and I'll be discussing the parties to a check. But first, let us define what is a check. A check is a financial document that directs a bank to transfer money from one account to another. A check is also some of the most important and common forms of negotiable instrument. Generally, there are two parties to a check. This includes the drawer and the drawee. Drawer. He is the maker of the check. He must be the holder of the account at the bank and must sign the check as per specimen signature, meaning that the drawer or the persons who draws the check signs in order the banks to pay the sum, while the drawee, he is the banker with whom the accounts or current are maintained by the drawer of the check. In short, the drawee are the bank or financial institutions with whom the check is drawn, or the drawee are the ones who are directed to pay the specified sum written in the check.
Thank you. A payee is a person or entity who receives payment for goods and services rendered or for a debt owned by another person or entity. The payee can be an individual, a company, a vendor, a contractor, or any other entity that is entitled to receive payments for a product or service. In other words, the payee is the recipient of the payment, while the payer is the one who makes the payment. For example, when you pay your rent, your landlord is a payee and you are the payer.
A bill of exchange, a short-term negotiable instrument, is a signed, unconditional, written order binding one party to pay a fixed sum of money to other party on demand or at a predetermined with a determined date. A bill of exchange is sometimes called draft or drought, but draft usually applies to domestic transaction only. Features of bill of exchange. It is important to have a bill of exchange in writing. It must contain a confirmed order to make a payment and not just a request. The order should not have any condition. The bill of exchange amount should be definite. Fixed date for the amount to be paid. The bill must be signed by the both drawee and the drawer. The amount stated on the bill should be paid on demand or on expiry of the fixed time. The amount is paid to the beneficiary of the bill, specific person, or against a definite order. Types of bill of exchange. Documentary bill. In this, the bill of exchange is supported by the relevant documents that confirm the genuineness of sale or transaction that took place between the seller and buyer. Demand bill. This bill is payable when it demanded. The bill does not have a fixed date of payment. Therefore, the bill has to be cleared whenever presented. Usance bill. It is a time-bound bill, which means the payment has to be made within the given time period and time. Inland bill. An inland bill is payable only in one country and not in any other foreign country. This bill is opposite to the foreign bill. Clean bill. This bill does not have any proof of documents, so that interest is comparatively higher than the other bill. Foreign bill. A bill that can be paid outside in terms of a foreign bill. Two examples of foreign bill are an export bill and import bill. Accommodation bill. A bill that is sponsored, drawn, accepted without any condition is known as accommodation bill. Trade bill. This kind of bill is specially related only to trade. Supply bill. The bill that is withdrawn by the supplier or contractor from the government department is known as the supply bill.
Good day everyone, my name is Maria Remedios and today I'm going to talk to you about promissory notes. Promissory note is a written document that contains a promise from one party to pay a specific sum of money to another party at a certain future date or on demand. It's a formal way of documenting a loan or debt agreement between two parties. There are two parties involved in promissory note, the maker and the payee. The maker is the person who promises to pay and the payee is the person who will receive the payment. The maker can be an individual, a business, or any other legal entity. Promissory notes are legally binding contracts, and both parties have rights and obligations under the contract. If one party fails to fulfill their obligation, the other party can enforce their rights through legal action. It is also possible to modify the terms of promissory note, but both parties must agree to the modification. They can do so by signing an amendment to the original promissory note or by signing a new promissory note that reflects the modified terms. Promissory notes are commonly used in business transactions as way to provide a formal agreement for loan or debt. They can also be used in personal transactions such as when someone lends money to a friend or family member. In conclusion, promissory notes are an important tool for formalizing loan or debt agreement between two parties. They provide a legal framework for the transactions and help ensure that both parties understand their rights and obligations.
Thank you. People, businesses, and governments all use credit instruments. There are various types available. They are bonds, loans, checks, and bills. These are the typical examples. According to Tatum 2023, items used in place of money are called credit instruments. On a daily basis, almost all kinds of people and companies utilize some kind of credit instrument. Such an instrument may be used in lieu of money, provided that both the debtor and the recipient consent to its use and that there is a reasonable expectation that the alternative form of payment would be fulfilled. Promissory note is a type of credit instrument. Check is one of the earliest type of credit instruments. Another prevalent or popular credit instrument is called credit card. It is so popular that according to the statistics or the data from Finder, 83% of Americans own at least one credit card and that they believe that by 2037 America will be cashless. This is the end of my part. Let us please welcome Mr. Santiago as the next reporter.
Thank you for joining us as we discuss credit instruments, their types, and how they play a crucial role in the world of finance. Let's recap what we've learned. Credit instruments are financial tools that enables borrower to obtain funds from lenders with the promise of repayment, often with interest, over a specified period of time. They are critical in facilitating borrowing and lending activities, helping individual businesses and government access capital for various purposes. We explore different types of credit, including loans, bonds, and credit loans, such as mortgages and personal loans are typically used by individual and businesses to finance a specific purchase or investment. Bonds, on the other hand, are debt securities issued by a company governments to raise capital from investors. Credit cards, a common form of revolving credit, allow consumers to borrow up to a certain limit and repay the borrowed amount with interest. We also discussed the importance of credit instruments in the economy as they provide liquidity, promote economic growth, and foster investment opportunities. Credit instruments allow borrowers to access funds not readily available while lenders earn interest on their investments. It's crucial to understand the risk associated with credit instruments such as default risk, interest rate risk, and credit worthiness of borrowers. Proper evaluation of this risk is essential for lenders and investors to make informed decisions and manage their portfolio effectively. In conclusion, credit instruments are vital tools in modern finance that facilitate borrowing and lending activities, promote economic growth, and provide opportunities for investment. Understanding the types of credit instruments and the associated risks is crucial for borrowers, lenders, and other investors to make informed financial decisions. Again, thank you for joining us for in exploring the world of credit instrument, and we hope the discussion has provided you with valuable insights into these important aspects of finance. I'm Reynolds Santiago, and thank you for listening.